Welcome to Breaking News to Trading Moves.
Today, we're looking at a development in the pharma sector. AbbVie reported a pretty large IPR&D charge, $2.7 billion.
Yeah, that number definitely caught our eye. And it's a good example, really, of how a company's spending decision can immediately flow through to their earnings report and, affect other companies too.
That's right. So our aim today is pretty straightforward. We want to lay out the context for this expense, look at the immediate financial hit, and then identify which companies and sectors might, well, benefit or face pressure because of this AbbVie strategy, this focus on their external pipeline.
Okay, so let's zero in on that headline number first. $2.7 billion. That's the core thing. AbbVie, ticker ABBV, taking that IPR&D expense in the third quarter. It's a big number, sure, but it also signals something about their strategy, doesn't it? Let's get into the mechanics then. $2.7 billion in IPR&D, in-process research and development. So this is basically the accounting value of drug candidates they picked up recently through deals, right? Stuff still in development.
That's exactly it. It's the cost tied to assets, mostly potential drugs, that aren't finished products yet. They were acquired or licensed as part of AbbVie's, recent business development push. It's the accounting fallout from that activity.
Right, and the accounting part is key here, I guess.
No, absolutely. You have to look at the accounting treatment to really understand why the market reacted the way it did. This charge, it's directly linked to the value assigned to these R&D assets when the deal happened. But here's the crucial part. It's a non-cash expense.
Okay, hold on. If it's non-cash, meaning cash didn't actually go out the door this quarter specifically for this line item, why does it cause such a stir? Why the immediate guidance revision?
It comes down to the accounting rules. GAAP, generally accepted accounting principles. Under GAAP, if you acquire an asset like a drug candidate that doesn't have another use and still needs a lot of R&D, meaning, success isn't guaranteed, you have to expense its value immediately.
You write it off right away.
You write it off right away, even if the actual payment happened earlier or is tied to future milestones. So that $2.7 billion hits the income statement as a cost in Q3, and it pulls down their GAAP earnings a lot.
So it's about when the expense is recognized on the books. The deals happened, cash was committed or spent then, but the P&L hit comes now. But hang on, don't big pharma companies usually focus on adjusted EPS? Doesn't that normally strip out these kinds of M&A costs?
You're right, they do emphasize adjusted EPS. And yeah, adjusted EPS tries to show the underlying operating profit by backing out things considered one-time or non-operational, and IPR&D often falls into that bucket for adjustment.
And not this time. Or not entirely.
Well, when the charge is this big, $2.7 billion in one go, it's just too large to ignore completely, even in the adjusted figures. It forces the company to update both GAAP and, importantly, their adjusted earnings guidance, too. And for investors, especially those who really value steady dividend growth and predictable earnings, seeing this kind of number, even if it's non-cash and adjusted out later to some extent, signals volatility. It just makes the near-term numbers look messy.
Let's put some numbers on that guidance impact then. Before this, what was the expectation for the full year, say 2025 adjusted EPS?
Yeah, the prior guidance was pretty solid. They were guiding to $11.88 to $12.08 per share. That was the range the market was working with. Now, post-charge, the new forecast is lower. It's $10.38 to $10.58.
Wow. Okay, that's a drop of about $1.50 at the midpoint. That's not trivial.
Not at all. It shows that even with adjustments, a spend of this scale has real consequences for near-term expectations. And it also meant their initial look at Q3 EPS, somewhere around $1.74.178, came in below what analysts were generally forecasting.
So putting it together, the market isn't necessarily reacting because a drug failed or something. It's reacting to the cost of AbbVie's choice.
The strategy here is key, right? This confirms they are really leaning on external deals to build their pipeline, buying future growth.
That's the narrative, absolutely. They're doing this as the revenue from their huge drug, Humira, faces erosion from competition. They need to fill that potential gap down the road.
Makes sense.
So they're aggressively outsourcing and doing deals in their core areas, immunology, oncology, neuroscience. Even while their newer big drugs, Skyrizi and Rinvoq, are ramping up, AbbVie is essentially buying insurance for its future revenue stream.
And this $2.7 billion IPR&D charge is the upfront accounting cost for that insurance policy. It tells us that securing external assets is priority number one for their capital right now.
Exactly. And the very act of taking this charge, signaling this heavy reliance on external deals and development, actually created some positive momentum for other parts of the healthcare ecosystem.
Okay, so who benefits when a giant like AbbVie spends big on external R&D? Well, first up are the contract research organizations, the CROs. These are the companies that pharmaceutical firms hire to actually run the clinical trials.
Right, the outsourced R&D departments, essentially.
Pretty much. The logic is clear. AbbVie brings in, say, a dozen new programs through deals that lead to this massive charge. These are external assets, getting clinical trials up and running for all these new candidates. Some might be early stage, some phase 2. It's often much easier and faster to hand that work off to a specialized CRO than to try and rapidly build up internal teams for everything.
So AbbVie's spending spree directly translates into more business for the CROs. It fills up their project pipeline.
Precisely. The deal flow indicated by the IPR&D charge is a strong signal of future revenue for the CRO sector. All these new programs coming into AbbVie's portfolio need development work, and that work often gets outsourced. It boosts the CRO's backlog, the committed future work they have lined up, and improves their revenue visibility. AbbVie spending externally validates the CRO business model.
Which CROs are we talking about here? The big ones.
Generally, yes. The largest, most global CROs are best positioned to handle the scale and complexity of trials for a company like AbbVie. So you think of names like IQVIA, that's IQV, and Charles River Labs, CRL. Their businesses are really geared towards this kind of large-scale outsourcing from big pharma sponsors. For them, AbbVie's charge isn't just noise, it's a sign that the volume of clinical trial work is likely increasing.
Okay, so CROs benefit from running the trials. Where else does the spending flow? You mentioned tools and suppliers.
That's the next category, the drug development tools and bioprocess suppliers. Running trials and developing drugs isn't just about people. You need the physical stuff, equipment, materials, analytical instruments.
Right.
So if AbbVie acquires, let's say, a new phase 2 cancer drug, they need to manufacture batches of that drug for the phase 3 trial. They need to constantly test its quality. The ongoing research needs specialized lab gear. Moving all these newly acquired programs forward requires a steady stream of specific equipment, things like chromatography systems, analytical tools, cell culture media, all that bioprocess stuff.
So more projects in an AbbVie's pipeline means more demand for the companies that sell these supplies and instruments. They provide the picks and shovels for the R&D gold rush, so to speak.
That's a good way to put it. This increased project volume drives demand for these solutions, used at every stage: research, trials, quality control, manufacturing, scale-up. We're talking about the companies that provide the essential infrastructure.
And who are the main players there?
You look at the life science divisions of big industrial or healthcare companies. Think Thermo Fisher Scientific, TMO, and Danaher, DHR. TMO sells a huge range of things, from basic lab supplies to really advanced scientific instruments. DHR is strong in areas like diagnostics, filtration, separation technologies, all critical for making biologic drugs. Their sales are often a good barometer of overall R&D and manufacturing activity in the sector. AbbVie's charge signals a commitment to moving projects forward, which likely means more orders for TMO and DHR down the line.
Okay, CROs, tool suppliers.
Yeah.
What's the third group? You mentioned biotech companies.
Yes, specifically U.S.-listed biotech firms that have assets that could be partnered or acquired. This is more about the M&A environment and valuation implications.
How does AbbVie's charge affect them?
Well, this $2.7 billion expense is like a big flashing sign confirming that major pharma companies like AbbVie are actively shopping for pipeline assets and are willing to pay substantial amounts for them, especially in hot areas like immunology or oncology.
So it signals that the M&A market for biotech is healthy.
Exactly. It confirms the appetite for deals is strong. For a mid-cap or small-cap biotech company that has a promising drug candidate, maybe something potentially best in class or in late-stage development, particularly if it's in an area AbbVie cares about, this news is encouraging. It suggests other big pharma companies might also be looking maybe more aggressively now.
And that gives the smaller companies more leverage in negotiations.
It certainly can. It potentially leads to better deal terms, maybe higher upfront payments, or just generally supports higher valuations across the board for attractive assets. When a major player like AbbVie puts such a big number on acquiring external R&D, it helps set the benchmark.
Can you give examples of companies that might be viewed differently after news like this?
You might look at companies with interesting technology platforms or specific assets. For example, Ionis Pharmaceuticals, IONS, they have a unique drug development platform. Or maybe a company like Viking Therapeutics, VKTX, known for some promising candidates in metabolic diseases, which is an area attracting a lot of attention. Investors might look at these and think, okay, if AbbVie is paying up for external innovation, maybe the assets held by companies like Ionis or VKTX are worth more than we thought. It validates the whole develop and partner or develop and sell strategy for biotech. Okay, so we've talked about the beneficiaries. Now let's flip it around. Who felt the pressure from this AbbVie news?
Right, because while the spending might be good news for suppliers and potential sellers, AbbVie itself took a hit on its guidance. That must have consequences.
It does. The immediate hit to AbbVie's own EPS guidance, plus the signal that this kind of external spending might continue, definitely puts some pressure on certain groups of stocks.
Starting with AbbVie itself, obviously, ABBV. And who else gets grouped in there?
Well, AbbVie first, yes. As we said, the lower EPS guidance range directly impacts how some investors value the stock, particularly those focused on near-term earnings predictability and often dividend stability. They just don't like seeing those big charges, even if they are non-cash or strategic.
That volatility is unwelcome.
Correct. And then investors immediately look around for peers who might be in a similar boat. Companies that are also doing a lot of M&A or face upcoming patent cliffs. That's where a name like Bristol-Myers Squibb, BMY, often comes up.
Why BMY specifically?
BMY has also been very active with acquisitions recently, dealing with their own patent expirations. So the thinking is, if AbbVie is facing this kind of accounting volatility from its deals, maybe BMY could face similar issues as it integrates its own large acquisitions. The market kind of links them because of that shared reliance on big M&A deals for future growth. So bad news on deal accounting for one can create nervousness about the other.
Okay, so AbbVie and maybe BMY feel direct pressure. Does that nervousness spread further?
It can, yes. That leads to our second category, which is kind of a broader sentiment effect on the dividend-tilted mega-cap pharma group.
So not necessarily companies doing the exact same thing, but just big pharma in general.
Pretty much. When a major company like AbbVie, a pillar of the sector, reports a multi-billion-dollar charge and cuts guidance, even if there are good strategic reasons, it can make some investors generally anxious about the whole sector.
They start wondering if others will follow.
Yeah, the question becomes, are other big acquirers, companies also doing deals to refill their pipelines, going to report similar charges and guidance cuts? Is this kind of accounting noise going to become more common?
And that worry weighs on stocks like.
It can affect sentiment around names like Pfizer, PFE, and Merck, MRK. These are huge companies, often held for stability and dividends. Any hint of increased earnings volatility or unpredictable accounting across the sector, especially related to M&A integration, can make some risk-averse investors pull back a bit, potentially causing their valuation multiples to ease off temporarily.
Got it. So immediate pressure on ABBV and peers like BMY, and then a broader sentiment shadow over other large caps like PFE and MRK. What's the third category? Competitors.
Yes, Category 3 is thinking a bit longer term. The near-term competitors who now have to deal with potentially a stronger AbbVie pipeline down the road.
Ah, so this is about the strategic impact of the spending itself.
Exactly. The fact that AbbVie is spending heavily on external assets signals they are serious about beefing up their future franchises, particularly in areas like immunology and oncology. They're not just going to sit back while Humira fades. They're actively buying their next wave of competitive products.
And that means tougher competition for others in those fields.
That's the implication. This strengthened pipeline means companies competing in similar therapeutic areas are likely going to face more intense competition in clinical trials and eventually in the marketplace a few years out. AbbVie spending today translates into competitive pressure tomorrow.
Who would feel that potential future pressure most?
You'd think about direct competitors in their key areas. Companies like Amgen, AMGN, which competes heavily in immunology and other areas, or Eli Lilly, LLY, which is a major player in immunology, oncology, and diabetes obesity areas, where AbbVie is also active or expanding. The market sees AbbVie making these investments and understands it's shoring up its future. This means AMGN, LLY, and others might face a tougher fight for market share with AbbVie's next-generation products. That $2.7 billion charge is essentially the down payment on future market battles.
Okay, so looking ahead then, for you, the listener, trying to sort this out, there's this tension, right? Is the stock's reaction just about a short-term accounting hit, or is it a deeper concern about future cash flows?
That's the core question. You've got this duality. There's the immediate impact of the non-cash charge, which muddies the near-term earnings picture. But then there's the potential long-term gain from having a stronger pipeline filled with these acquired assets.
AbbVie basically chose to take some accounting pain now for potential pipeline gain later.
Right. They made a bet, sacrificing some near-term reported numbers clarity for future revenue streams. And successful pipeline assets are often what drive long-term value creation in this sector, arguably more than hitting every quarterly EPS number perfectly.
And how does this play out in terms of relative performance between the winners and losers we discussed?
Well, if investors get more worried about this IPR&D accounting issue becoming a recurring theme across big pharma, so affecting BMY, PFE, MRK potentially, you could see the valuations of those large cap stocks stay under a bit of pressure. Investors might prefer companies with less M&A integration complexity for a while.
While the beneficiaries,
Yeah.
the CROs and suppliers, might do better.
Potentially, yes. The CROs like IQVIA and CRL and the tool providers like TMO and DHR could show relative strength. Their business models benefit from the activity itself. More R&D projects, especially outsourced ones, means more demand for their services and products. Their earnings visibility might actually improve precisely because companies like AbbVie are doing these big, sometimes complicated deals. So you could see a divergence there.
Makes sense. So what should people watch for next to get more clarity on this AbbVie situation?
There are a few things. First, keep an eye out for any follow-up regulatory filings from AbbVie, like an 8K, or listen closely to their next earnings call commentary. They might provide more specifics on which assets or deals made up that $2.7 billion charge.
Knowing where the money went is key.
Absolutely. Was it one big late-stage asset or lots of smaller, earlier-stage bets? That tells you a lot about the risk profile and the potential timeline to see returns. And the more early-stage stuff they bought, the more work there's likely to be for the CROs and suppliers down the line.
What else?
You also need to keep tracking the performance of AbbVie's current growth drivers, Skyrizi and Rinvoq. If those drugs keep growing strongly, it helps justify the big investment in the next wave of products. And finally, watch AbbVie's commentary on future business development. Was this $2.7 billion charge related to a one-time burst of deals, or is this level of external spending going to be the norm for a while? That tells you about the sustainability of the strategy.
Okay, so let's try and pull this together. AbbVie took a clear hit to its near-term guidance because it chose to spend big on external R&D to secure its future.
Right. A strategic choice with immediate accounting consequences. And that choice created winners, the service providers like CROs and tool companies, and maybe potential biotech targets and losers, or at least companies feeling pressure, like AbbVie itself, peers sensitive to M&A accounting, and potentially long-term competitors.
It really highlights that tension between near-term results and long-term strategy in pharma.
It does, and it leads to a final thought for you to mull over. How should investors really weigh that trade-off? How much importance do you place on smooth, predictable quarterly earnings versus a company's clear, albeit costly, commitment to building its future pipeline through external innovation? It's not always an easy balance.
Indeed. And just a reminder to everyone listening, this discussion is based on our analysis of the information available. It reflects the opinions of the author. It's definitely not financial advice, and it's not a recommendation to buy or sell any stocks.
You should always consult with a qualified financial professional before making any investment decisions.
Thanks for joining us on Breaking News to Trading Moves.